Al Brooks, the godfather of price action, teaches us that 80% of the time, a stock trades in the range. But most traders never use this to their advantage. You can collect premiums from both sides of the range. I placed over 200 of these trades since 2018 with a 90% win rate. Today, I'll show you the risk and trade management of this strategy. It's very easy to put on a trade, but how you handle and manage a trade, that is actually the hardest part. We're going to talk about a few scenarios. First scenario is profit taking. Profit taking when we're making money and when we're winning. The second scenario is when we only have 21 days to expiry. What should we do then? The third, a very important scenario, is what if we're losing? What if the stock moves? What if it gaps up or gaps down and it's not going well? What should we do? We have to take a loss. And I'll be explaining the best practices on how to stop out. And last but not least, we're going to talk about rolling. So the first case is profit taking. We take profits on these short strangles when it hits 50% profit. Okay, usually that takes about half of the time. So if you sell a 60-day strangle, usually around 30 days, you're going to be hitting 50% profit already, and you're going to exit then. Very simple. So if you collected $100 in premiums, when it reaches $50, you're going to exit. So you're going to make 50% of your max gain possible. The second case is if your time left in this trade is only 21 days. Usually you're going to be having a small winner because obviously if you hit 50%, you exited already, right? So it means you probably have a small winner right here, and you can choose to close it out. Okay, it can be a small winner or loser. Okay, you can choose to close it out, or you can roll the contracts out further out in time. And I'm going to be talking about rolling, and I'm going to give you an example of how to roll in case number 4. Case number 3, this is very important. We will close the whole trade if there is a 200% loss on this trade. So let me give you some numbers here. Say we collect $100 in premium for this trade. If this trade goes against you and hits $300, so that's 200% loss, we're gonna close it out. So you're gonna lose $200. Why? Because $300 minus the $100 in premium you collected is $200, and that will be your max loss. This will be your defined max loss, and you have to respect this. I repeat, this is so important. You have to respect your stop loss plan. Okay, so 200%. Keep that in mind. Case number 4, rolling. So remember I said at 21 days, losing or not, we have to either close the trade or roll the trade out. Because under 21 days, there's gamma risk. Basically what that means is the delta change will be very strong now. So either we close it out or we roll it out. Okay, so how do we roll? What does rolling mean? Okay, so we're gonna buy back the short options, okay, the 21-day options. We're gonna reopen and sell another put and call further out in time. So the next monthly cycle. So that's gonna be about 30 days further out. So you'll usually get a 50 to 53 days renewal to your contracts. You can choose the same or different strikes, okay? Now, you wanna look at the chart and see if you wanna rebalance the deltas to neutral, okay? So if your trade, if the underlying, the stock did not move, then you can just roll out the deltas. If it's like 20-20, 15-15, if it's still healthy and it's delta neutral, then just choose the same strikes. However, a lot of times at 21 days, you still didn't close it out at 50% profit. And the reason for that is because the stock moved up or down. So the deltas are no longer balanced. You can choose to, based on your technical analysis, to rebalance the deltas to neutral. So say one of your contracts, say the put side, it's like 30 delta and your call side is maybe like 8 delta, then you want to rebalance it and make it maybe 20-20 again at 51 days out. Okay, I will show you an example when I go in Tasty Trade platform to show you guys. You always have to collect a credit. I repeat, you always have to collect a credit when you roll. Let me show you some live example of rolling. Let's just say we have a trade on Uber and oh wow, it's exactly 21 days. Say we had something like this and it's at 21 days, it did not hit our 50% profit take rule, and we want to continue to be in this trade because we still see Uber is in range. Okay, so right now Uber is still in a range. We think, okay, let's just renew the contract. I still believe it's gonna trade sideways. So what we're gonna do is we're gonna buy back these contracts, turn it green, make sure it's B, okay? And we're gonna go to the next monthly cycle. So this 69 and 77. We're gonna go to the next monthly cycle, so 56 days, July 17. There's no 69, but there's 70. And there's 77, range to 77.5. Okay, so that's our range. And you can see it when I buy back and sell these new contracts, I'm actually collecting $2.86. That's $286 for rolling the contract out. So from 21 days, I go to 56 days, I actually make more money for rolling this contract. And I will collect $2.86. That's decent. And that's how you want to roll. If you want to widen the strikes, sure, go ahead. But make sure you're collecting a credit. So you can drag this. We can actually widen the range to 65 and 77.5 instead of keeping the same strikes. And actually that's better because your chance of winning is greater if you make a range bigger. So in this roll, you actually make $1.60, $160 for just rolling out in time. I like that a lot. I'll probably do something like this for $220. Widen the strikes. All right, traders, that's the 4 scenarios of what you need to do to manage the trade. Okay, the most important one is actually the stop loss. Don't forget about that. I hope you enjoyed this 3-part lesson on short strangles. Trade small, trade safe.